The last component of the actual chapter concepts is this one. Then I'm going to have to kind of, although I've been doing it all the way through, kind of say here's how this all flows into the homework. I don't know that I need a video necessarily or just a list, because all of the videos up to this point have kind of been leading us through what we're going to need to do in the homework. This one kind of brings everything together, including things from a couple of chapters back. So bear with me as we kind of hit this. We're going to be assessing the financial projections in a corporate planning kind of way and try to bring this full circle and then say, so what could we do better as managers to maximize shareholder wealth? Well, to begin with, we have to know more fully what generates shareholder wealth. So if markets are efficient, then we would expect the stock price to be the present value of either the expected future dividend or the expected future cash flow, free cash flows. We talked about this in fact the last homework assignment and the last chapter that we covered. We said, and in fact the last two, because if we go back two, then we were saying here's how we assume the market is looking at stock prices, and we looked at about 3 different models. One of them looked at dividend discount, which we did last homework assignment. One of them looked at the expectations for future, what I called net free cash flow, because it would take net income and try to pull a cash flow measure that was aimed primarily at shareholders. That's what we're going to be doing in this homework assignment, pretty much. So as a first use of a final financial statement projection, we should first off look at that simplified statement of retained earnings to see if the current dividend policy that we talked about last homework assignment is in fact sustainable. We made a few assumptions as to what that was going to look like. How much were they going to pay in dividend? How much were the dividends going to grow from year to year? And the financial statements now are saying here's what we think that they can throw off as far as cash is concerned. We should be able to see retained earnings growing. We should be able to see cash at least not getting worse. And when I say cash position at least not getting worse, we should not see those revolving loan numbers growing over time. Mine were pretty flat, but if yours start growing, or if you had short-term investments and those short-term investment balances are now going down over time, you're actually seeing longer-term cash losses rather than cash flow. And again, you really can't do that long term. So we should be looking for cash that's sustainable, that's level or growing. We should see retained earnings that are level or growing. And in both instances, Rocky Brands has passed that test, and I'm hoping that yours is passing that test as well. I say in this, check to see that your change in retained earnings is increasing. But by the same token, as we talked about what those revolving loan and short-term investments were doing, if you see the short-term investments going down or you see the revolving loan going up, that's a bad sign. That means the company is not generating enough cash to actually maintain their current position. At this point, though, we're going to look at that second model. There are many ways to model free cash flows. In an earlier lecture, we considered what I called net free cash flow for stock valuation. And I'm going to review that in just a sec. As a first attempt at valuing using free cash flow, and really the only attempt we're going to be making, because I can think of ways of getting at a better estimate of free cash flow. Most of you just don't have the finance or accounting chops, so to speak, to be able to get through this, especially online. So you'll just kind of bear with me as we do what I used to call this the quick and dirty method of coming up with cash flow. And then I would have students who would call it the Q&D method. I'm going, what is the Q&D method? That's when I realized they were using my own term, quick and dirty, throwing it back at me in abbreviation form. And I'm going, oh, okay. I'm the only one who uses that, so don't be going out going the Q&D or the quick and dirty. This is just a really fast way of coming up with a net cash flow that kind of works. So what we're going to do is we're going to take net income, projected net income. We're going to add back what we expect depreciation and amortization to be, and I'm going to have to do that one first. So I'm going to estimate depreciation and amortization for the entire firm. Then we're going to, we've already estimated net income. We'll add back the depreciation and amortization. And then whatever that number is that is kind of that quick and dirty estimate of cash flow, net cash flow, we're going to divide by the number of shares to kind of get net cash flow per share. Then we can start looking at stock price. So here we go. As a first step in assessing the stock price, we will consider the estimates of free cash flow per share as the cash flow in the numerator of the non-constant growth model, that Gordon non-constant growth model, as we remember. Then we're going to discount those cash flows, allowing for the cash flows to continue to grow at a constant rate from time 6 to infinity and beyond. And then we will quickly review the methodology. In fact, right now we're going to quickly review the methodology of the non-constant growth model. Then we're going to apply it to my example firm, and hopefully you'll see what I'm doing, because I'm going to be doing, here's what we said in chapter 7. Here's how it applies to my company, and it will apply pretty directly. And then hopefully you'll go, okay, I get it. But we're going to have to make another assumption, which basically means we're going to have to say, here's what I'm assuming the growth rate's going to be from here to infinity, from 6 to infinity. And yeah, so here's my example. This is just a review. You've already seen this. If Buford's Bulldozer is expected to earn the following net free cash flows per share, and then grow indefinitely at 4.5%, assuming a discount rate of 14.5%, what would its stock value be? And this is what we're going to be doing. So here are my net free cash flows. Now we're going to be able to do this, come up with net free cash flows from our financial statement projections at this point. And so with this example, though, we're going to take these 5 numbers and we're going to throw them in this. And first thing we need to do, believe it or not, is start at time 5 and say, what would the stock price be at time 5? Why? Because we can use that Gordon constant growth model for time 5. And what it will do then is take all of the cash flows from time 6 to infinity and give me a present value at least at time 5. So it will be a future value for now, but at time 5 it would be a present value of all of those up through from 6 to infinity. And so that's what we're going to start with. So we're saying P5, that's the price at time 5, is going to be expected dividend at time 5 times 1 plus G divided by R sub S minus G. Remember, our R sub S comes from the stuff in chapter 6. Remember that dividend is really the cash flow at time 5. Let me just go back and show you where that came from. That's 3.20 right there, time 5. 3.20. That's $3.20. I'm assuming that is their net free cash flow. So plugging and chugging, I get the 3.2 times 1 plus the growth rate divided by 1 by the R sub S, which I got from the stuff in chapter 6, minus my growth rate gives me 33.44. And so many people go, oh wow, I finally finished it. That took a lot of mental constipation. But no, that's only the first input. We need all of the periods. So that was just from 6 to infinity. Now we need 1, 2, 3, 4, and 5. So that's why we're putting it all together. Time 5 has the time 5 number in it, the 3.2, but it has all the stuff from there to infinity, which I'm calling quote, stock value, unquote, because if I sold it at that moment, that's how much I would expect. And what I would expect is the value at that moment of all the future cash flows from then on. And so I add them all up so that at time one is $1.25 plus 0 is $1.25. Time two, $2.75 plus 0 is $2.75, and so on until I get to time 5 when I get 3.20 plus the 33.44, which is everything after that in time $5, and I get 36.64. Now I've got 5 different numbers, but they're all in different times, and so it's sort of like they're all in different currencies because I need to spend them today. So what are they all worth today? Well, that's when I start discounting them at the 14.5% level. Where did the 14.5% come from? Again, that's the outcome from my capital asset pricing model, and it came from chapter 6 stuff. So here are all of my cash flows: $1.25, $2.75, $1.50, $2.80, and $36.64, which is the 320 plus the 33.44 from my Gordon constant growth model. And then I start discounting them at $14.50, and then I add them all up and I get $24.44, and I'm done. That's what we're going to do here. Before I get started though, let's see, what do I have? I've got my income. I'll be able to figure out what the dividend I'll be able to figure out what the depreciation and amortization is because I have a method of doing that I haven't shared with you, but I will in just a sec. I have number of shares because I had to do that for the dividends already. So I can divide everything by the number of shares and get the net cash flow per share. I have already done my beta calculation and therefore my required return. That's my R sub S. The only thing I don't have is my G, my growth rate. So let's go talk growth rate. So the price of the stock is highly dependent upon the growth rate you choose, because it's in the numerator and denominator of the Gordon constant growth model. Remember, therefore, first off, that the growth rate G is the expected long-run growth in free cash flows from time 6 to infinity. Yes, in the end, we're going to have to say, here's what I think would be a reasonable G. Then we're going to ask, how fast has it been growing in the past? And this is free cash flow now. It's not dividends or anything else. It's free cash flow. How fast can it be expected to grow once the company matures? Because that's really what it's looking at, because it goes to infinity, which means it keeps going for ever and ever and ever. After the company has finally matured, how fast is the normal growth rate for this company? That's really what we're looking for. 2, growth rate is nominal, meaning it has inflation embedded in it. Inflationary expectations are embedded in it. Meaning, if I am so mature that I don't think this company is actually going to grow any market share whatsoever, and it's not going to grow in real terms at all, the only thing that it should grow in then is inflation, because their input prices will go up by inflation, and their prices should go up by inflation, and their profits should go up by inflation, and therefore the amount of free cash flow that they throw off will probably go up by inflation. So at the very least, we should be looking at 2%, and if we're thinking that it's not growing at all, that's actually like 2% growth in nominal terms. And so we would put 2%. And if you put 0%, what you're really saying is they're actually contracting in real terms. The last thing we need to say is G is going to be less than R sub S. So whatever R sub S is, we need smaller than that number between time 6 and infinity in growth rate per year, or we're kind of messed up. We'll have a price that's infinite, which is probably not realistic. So having said that, let's jump over and start looking at our company and say, so what does it all mean? I'm starting with the historical stuff because the very first part of this means we're going to have to look at the depreciation and amortization. By the way, this is not accumulated. At the end of the last video, I looked at how would I model accumulated. This is really not accumulated. This is amortization and depreciation expenses. And those could be they don't have to be completely connected with accumulated depreciation or accumulated amortization, because those assets may be sold, and if you sell an asset that's partially depreciated, that accumulated depreciation leaves as well, even though you may have expensed part of it this year. So the two aren't completely the same, because companies are sort of like living, breathing organisms, sort of, so to speak. At least their numbers seem to be, because they're not quite as simple as people want them to be. And so I'm going to go to the cash flow, by the way, just so you know where I'm going, because this is the best place to find the depreciation and amortization. What I'd like to do is say that these numbers have something to do with the level of gross fixed assets or net fixed assets, whichever one your company is disclosing easily on the balance sheet. I don't want to kill you. I think they are better. They're better estimated with gross fixed assets, but I'm going to use net fixed assets because that's what my balance sheet has, and I don't want to kill myself, and I don't want to kill you off. I don't mind killing myself off usually, but not students. So I'm going to be coming here, grabbing these numbers, and at the bottom of my balance sheet over here, this is again the historical balance sheet. I'm going to be, so down here at the bottom of the balance sheet, what I'd like to do is look at depreciation as a percent of net fixed assets. I'm going to move over and then say equals cash flow divided by, and because I have net fixed assets, that's what I'm going to be using, fixed assets dash net. What frustrates me sometimes is people will be telling me, my company doesn't have this, that, or the other, because it has a slightly different label on it, and I'm hoping people will have a broad enough mind to actually figure out that net fixed assets could say PP&E net, which is property, plant, and equipment, or a whole bunch of other things. So, you know, look at it and see what makes sense to you and go for what makes sense, because I can certainly fix whatever you may get wrong in it. So once I have these, I'm going to highlight them again and look at the average, and interestingly enough, it's 25.5%. Wow, how cool is that? Really right in there, right what I kind of wanted. You know, that's easy to remember, let me put it that way, 25.5%. At this point, I need to actually apply this. Now, in this instance, I'm going to be putting it on the income statement just because I'm going to be adding it to net income. So I'm going to be saying expected, or maybe better yet, projected depreciation and amortization expense, and I'm going to say is equal to 0.255 times this 25.5%. For those of you who are wondering where that came from, that's the one that we just barely did, because people go, what? That's the 25.5%. I'm going to scroll back up here and say, here are my fixed assets that I'm going to need or have at the end of that time period. And this is the approximate depreciation and amortization per year. And it's going to grow slightly as we add more new fixed assets. So at this point, I'm going to say total net free, and let me put my parentheses around my quotation marks, because I'm the only person who calls them this, net free cash flow, which is going to be equal to my net income plus projected depreciation and amortization expense. And so we're getting some fairly decent sized numbers here, it looks like. I'm going to skip down here a little bit and say, therefore, these are my net free cash flow, cash flow per share. Guess what I should do is say projected net free, wow, got carried away there with the E's, cash flow per share. And this is going to just be my net free cash flow divided by the total number of shares. Usually I will get to this point and people will go, I'm lost, I can't remember what we're doing, I'm just following steps and not really getting what you're doing. But they won't really usually ever tell me. They'll just look at me with that deer in headlights look. So here is what we're doing. We just calculated the net free cash flow per share. It's net free cash flow because we've taken the net income and we're adding back things that have nothing to do with cash, like the depreciation and amortization expenses, not the accumulated, the expenses. Then we get what some people do to get a really quick and dirty estimate of cash flow to the shareholder. So here's what we're looking at now that I have those 5 net free cash flows per share. I'm looking at this little table that was at the bottom of this example where we had Buford's bulldozer expected to earn all of these net free cash flows at the bottom. And then after that, we're assuming that those free cash flows will grow from year 5 at a rate of 4.5 per year forever. Why? Because we have to make some assumption. Otherwise, we'd be doing an infinite number of things out there, and it's just not going to happen because we'd be doing it, well, forever and get very little out of it. So we make a simplifying assumption at the tail end, and then we figure out what the discount rate is. So, since that's what we're going to be doing to find out what the stock price is, or the appropriate stock price is, here's how we did it to begin with. We came up with the net free cash flow numbers, which we just did for our company. Then we said, first, let's look at the stock price at time 5. Really? What do I have to do that? Let's see, D5, that's really, even though in the dividend discount model world that was a dividend, that's why it's a D, we're using this as a cash flow discount model, and so we're saying, okay, let's, kind of snicker and say it's really not a D, that's a cash flow. And that's what we're doing. We're going to say that's that cash flow at time 5. So I'm going to look at cash flow at time 5 times 1 plus G. Well, I haven't estimated G yet. Divided by R sub S. Well, I don't remember what R sub S is. Minus G. And so I'm going to need to put in a G, come up with a G, come up with an R sub S. And then we can at least come up with this number of what the price would be at time 5. But remember, even then we're not finished. So let me get to this point and then come back. So, getting back over here, let's take a look at the two things that I don't know what they are yet. First, long-term growth rate. Remember my 3 concepts. Number 1, that this is a long-term growth rate. It's not for what's happening over the next few years. It's for what's happening over the long run. Over the long run, how fast should net free cash flows grow? Probably not a real fast. Also remember that these are nominal rates. That means that we should be taking into account that inflation is happening, which means that if we say 0 growth, well, that's probably not likely because inflation happens. And so somewhere in there, one thing we could do just as a beginning point is say, let's take a look at how fast we are projecting it to grow. Because if we're way off, that's part of the easy ways of figuring, okay, what in the world were we thinking? Or what in the world were we smoking? So I'm going to be looking first at the rate, and I'm looking at these numbers right up here that have my projected net free cash flows. I don't have any observable net free cash flows. I mean, I guess I could go back and add back depreciation to net income and look, but that's not what I'm doing. I'm going to look at my own projections. And if this is times 0, then this one's 1, 2, 3, 4. I only do that because if I don't do that, then people will go, wait, you have 5. Yeah, but this one's times 0, and then 1, 2, 3, and 4. That means the number of periods is actually 4. The payments, we're not looking at payments. And present values, it's like I'm going to have to forego this number to get this number later. And we just want to say, so if that's true, how fast is it growing? I know what you're thinking. This isn't a net present value kind of thing, but it will give me the growth rate. And it gave me a 7%. We're really a 6.87%. So that's the first input. The other input I need is an R sub S. This was our calculation of beta and all of that jazz. So what I'm going to do is I'm going to grab my beta. I'm going to just do a copy. I'm going to come over here and do a paste special. And tell it values. I know there's one of those little icons, but I hate to even look for them. It's easier for me to look at the words, and I'm dyslexic. That should tell you how badly those icons do at conveying anything. So this is my beta estimate. Then I'm going to look at my risk premium, and then my risk-free rate. And since I'm being anal, I think I'm going to subscript the RF. And then I'm going to look at RS, because I'm then ready to look at RS. So let me grab my S, just the S, thank you very much. And we'll subscript that one as well. And so my risk premium, and the risk-free rate that we used, I think, was a 20-year treasury. I'm going to assume that's what it was. It's about 2.8% right now. So I'm going to say 2.80% for risk-free rate. Wow, I was way off. Well, not way off, but okay. For the risk premium, I'm just going to do a 6% rate. And then this is going to be equal to my risk-free rate plus the product of these other two, because I'm looking at risk premium, which is the hypothesized difference between the market, the return to the market, and the risk-free rate. And I get a huge number. No, I actually get a 9.5% number. Okay, now that I have all of my inputs, I have my D, or cash flow, at time 5. I have my growth rate, and I have my discount rate. And so at this point I can finally get around to saying P, 5. Wow, I'm bad at getting what I want because I keep trying to push shift when I don't want it. Guess I'm just a shifty character. Yeah, okay, I'm a dad too, so I have really bad jokes. So equals the cash flow at time 5 times 1 plus growth rate, close parenthesis on the numerator, divided by, open parenthesis, discount rate minus growth rate. Now, by the way, this is going to be way higher than than the market is seeing today. And I think it's because my net income is higher than we are actually realizing, and I think that long-term growth rate is a lot bigger than it ought to be. So I'm going to hit enter, and again, this one is not observable today, but it's going to be ballparked with what it would be today, I believe, based on not much growth in here. So we're at $13-ish rather than 64, so that's way off. But we don't have P sub 0 yet, so before we get into what the price is today, let's remind ourselves what we're doing again for those people who got completely lost. So remember, we're doing something like this example that we did way back when, okay, a couple of chapters ago. We're trying to find the present value of this story problem where we have our net free cash flows, 5 of them. Wow, that's exactly how many I have. And then we have a discount rate and a growth rate. Oh wait, I just did those. So step 1, we're going to look at the stock price. I'm putting quotation marks around that. Here you just can't see it with my fingers. Just pretend like you can see it. So stock price, because what this is really in time $5, the value of everything beyond time 5. So 6, 7, 8, 9, 10, all the way out to infinity. No, I'm not going to count that far because I'd never stop. So P5 is going to be equal to that cash flow at time 5, 1.6, times 1 plus the growth rate of 6.87%, divided by the required return, 9.5%, minus the growth rate, and we got like $65. Okay, so that's the first step. Second step, we're going to have to then sum all of the period cash flows like this. Now we could put it in exactly this format, and it would probably mean a lot more, but usually that's going to take me way too much time. So what I'm going to do instead is, if you can visualize this turned sideways, way at the top of my spreadsheet I have years. They go 2014 through 2018. Down where I am, we have these individual cash flows. This one says dividends, but these are cash flows, okay? And then I have this stock value. And then when we did this before, I had these pluses and equal to. So the $1.25 plus 0 equals $1.25. $2.75 plus 0 equals $2.75. All the way down to $3.20 plus $33.40. That's the only one with any current, stock value stuff in it. Is equal to $36.64. Oh, so I should just do the same thing here. Let's do that first off. And I'm going to show you what I mean when I say turn it sideways. So down here I'm going to say these are my net, these are the cash flows for discounting. I'm going to say is equal to that number at time 1, that number 2, 3, 4, and 5. Except on this one I'm going to have to edit by coming up here, and instead of just saying it's that one number in 2014, I'm going to have to say, yeah, it's that number plus everything that comes after that, just like we did in the other one. So, and everything after that is that P5. Okay, so we're taking whatever we have in time 5, because these are all in time $5, we're adding the present value at that point of everything beyond that, because it's been discounted to time $5. Now we're going to have to translate it into time $0, and I'm going to say enter. So that one's huge and everything else is not. And then I'm going to come down one more and say P0. Don't worry, I'm going to show you this one too. I just need to label it. So label what I'm going to be doing next. So far we've got all of those. What I want to do now is I'm going to turn these that I had sideways in the same order that we have them in hours. So it'll be looking like this. We have our net free cash flow per share in time 1, then 2, then 3, then 4, and then 5 is added with that piece of 5, okay? And then we're going to take all of these free cash flows and discount them at the discount rate, the R sub S, the 14.5. Now notice this has nothing to do with the growth rate anymore, because that's already embedded in that time 5. And I'm going to discount $1.25 at, if I were to do $1.25 at 14.5%, it would be $1.09, and so on, and so on, and so on, and so on. And then I'm going to add them all up. So these are all present values. When I sum them, they become a net present value, so to speak. And say, okay, this is an equal net present value. I need the rate, again that was R sub S, comma, all of my values. Enter. And I get 46.67. Well, that's way high. It's way higher than $13. And so what I would end up doing at this point, so now we got something that bears no resemblance to the world in which we live at all. Now, what I have found, by the way, before I get into this too far and before you beat yourself up too much, if you have run in the last homework assignment a value of the company using a true dividend discount model where you actually discounted the expected dividends into the future, if we have done that, then chance, and if it has worked, in other words, it came really, really close to my stock price without even any tweaking of anything, it just came really close to stock price, then they are probably using that to come up with the stock price. Especially if you did that one and it was way off, that one was almost dead on, and you do this one and it's way off. I found that some companies will use one, or for some companies they'll use one, and for other companies they will use the other model, meaning the free cash flow model. And so if you were really close on that one and this one's way off, don't be so concerned about it. But mine wasn't that. Mine was not true that way. I can't believe what I ended up with there. This one I feel like should work, and it isn't. So after we've calculated the price using what we have termed the net free cash flow non-constant growth method, we'll compare the price we calculated to the market price. And just so you know how we do that, I would go to Google Finance and type in your ticker symbol, and in my case it's $13.17, which is a far cry from 46. So I need to go back and do some heavy readjusting. What that probably means is the market is seeing less in the way of free cash flow than I projected. So I need to butch up and say these people have lots of money on the line and assume that they're right and I'm wrong. So I'm going to go back and tweak my income statement. So the biggest input here is my income statement. So I'm going to go up here and maybe, there are a few things I can do here, by the way. I can actually make these so that they don't grow quite as quickly, because I tweaked those up. I can also, if you remember correctly, with these costs of goods sold, I ended up making them not grow, even though it's been clear that in the past they have in fact grown. And in fact I should have gotten rid of all of these in the first place, but I guess it's a good thing I didn't, but I'm going to do so now. So I'm going to come over here and say, okay, let's assume that's 66.5 and this one is 66.6 and this one is 66.7. 7.5, so it grew a little faster that year. And then 66.8, and then 66 point, no, maybe 67 point, just to be letting it round up a lot. As I scroll down, I want to make sure that these are still kind of positive, which they are. I want to make sure that I'm still able to have positive change in retained earnings, which I am. But before I look at the prices or anything else, I need to go back and look at the balance sheet and scroll down, because you'll note that, oh crud, I'm out of balance. Yeah, because I just adjusted how much retained earnings they're going to be having. And so the very first thing I need to do is probably go back and use my developer tab in the ribbon and run the balancer macro, and it shoots it back down to 0. Then I'm going to go over my income statement and scroll down, and I'm much closer. So I'm closer to what the markets are seeing. And the only other thing that I think I would do with this particular company is perhaps get these sales numbers. I'm just going to copy them, bring them down to an extra line down here somewhere, dump them in. Whoops, I put them in a weird place, so let me dump them in down here and say I'm going to call this archived sales. And I'm going to say this one, let's assume, is 0.99. I'm just looking at that one's, let's bring it down 1%. I'll bring that down 2%. I'll bring this one down, whoops, 3%. And I think I'm just going to have it do the rest of them. So this is percent of original projections. And I'm going to say is, and then this one is revised projections. And I'm going to just say equals this number times that number. And I get a new estimate. I'm going to copy those, go to the top, right click, and paste special just values, and I dump them in. Then before I do anything else again, I'll go to balance, and yes, I'm off again, which means, darn, I have to go hit the macro button again and rerun. That was so hard. Then I'm going back over to my income statement and scroll down, and now I'm in the neighborhood. You'll notice that this one, though, has changed all over the place. I don't really like that 0.79 negative anyway. If we're flat, meaning we didn't grow at all, I would have 2% growth, so let me do 2. That puts me really, really close to where I am right now. And because I'm really, really close, I'm going to do the last thing, which is go up to Data, What If Analysis, Goal Seek, and do the following. I'm going to set the cell I'm on, which is the price, to my $13.17 that I just saw by changing the long-term growth rate, because I'm around 2%, but it could be higher or lower. This one's going to bring it down just a smidge. So I'm going to now say OK, and it brought it down to 1.23%. So I'm going to say OK. And now I have a consistent estimate. So here's what I'm recommending. If we're substantially off after we run our price, we should tweak our cash flows. what I've demonstrated is tweaking a couple of inputs that I never felt super duper confident about. One of them was my sales projection, which I backed off just slightly, and the other one was the cost of goods sold assumption, which instead of holding it constant, I allowed it to grow slightly. Once we've done that, and we're within about 10% of the observed stock price, we should then be able to use that goal seek on the growth rate and get something that is probably kind of close. But remember, the 1.23% would mean that over time they're losing market share, because they're, we would expect that to grow at about inflation. Our real point in financial management is to maximize shareholder wealth. So the question now remains, how can we improve the firm's stock price? And so what I'm asking us to do at this point, and this one is a little awkward, because I think if we got a better estimate of net free cash flow, you'd even see I was going to say huger, but I guess that's not a word, a larger change in the stock price. And this one will just usually gives you really puny ones, because it's just not a really super duper good estimate. So what I would do is go back to the stuff you did in homework 3, where I'm asking you to do an analysis of how healthy the firm is, and then saying what would you do to improve its health and its performance. And hopefully you came up with some recommendations. I did, and mine had to do with asset management ratios, having to do with both accounts receivable and inventory turnover. So I'm going to go back, I'm going to tweak those, and then I'm going to say, so what kind of a difference did it make to the price of the stock? Here's my projections worksheet, complete with the actual price. In fact, I'm going to make my price big and bold, and so that I don't have to look all over for it when the time comes to find it. So there it is. Okay, that's as big and as bold as I get, I guess. So there it is. And now I'm going to go over and adjust some of my assumptions. The assumptions I'm going to focus on are the accounts receivable, which seem really, really long. They have been 70. So what happens if I reduce that to 65 and then 60? And then I'm just going to say, and so on. And then what happens if the inventory goes down by like 10 days per year? So instead of 165, it goes to 155, then 145, and again ditto with the and so on. And then I say, so first off, that's going to adjust things, as I've already pointed out, at the bottom of my balance sheet. Wow, we're out of balance all over again in a big way. So at this point I'm going to go to developer, macro, balancer, run. We ran it, and at this point you'll notice that we have some major adjustments to my cash flow, because we've gone from kind of neutral to paying down this loan, which you can only do with cash, by the way, and then putting money away in short-term investments. Having said that, what change did it make to my stock price? Well, it went up, obviously, but I can specifically say how much it went up. And again, I think this is actually a low estimate given what has happened with their obvious cash flows. I don't think we're picking up all of it. And so it would do a minimum of a few cents a share, but a few cents per share when we're talking 7 million shares. Whoops, where are they? Well, I guess it's 6.2 million. No, it isn't. It is, it's 7.5 million shares. There we go. So if the value of the firm has gone up by more than, 50 cents per share, that means total shareholder wealth has now increased by $3.5 million, which is not chump change. And that's really what I want you to do with the homework. And that is probably plenty of work for you to do. So I'll see you in the next chapter.